Brad Williams, Frugal Finance, stack hedges versus strip hedges. Some situations require hedges of cash flows over extended periods. This type of long-term hedge protection can be employed in two different ways. First, future positions can be established in a series of future contracts of successively longer expiration. This is called a strip hedge. Second, the entire futures position can be stacked in the front month and then rolled forward, less the portion of the hedge that is no longer needed, into the next front month contract. This is called stack hedge. Each strategy involves trade-offs. The strip hedge has a higher correlation with the underlying risks than the stack hedge, i.e. has lower tracking error, but may have higher liquidity costs because the more distant contracts may be very thinly traded and may have high bid-ask spreads accompanied by high trade execution risk. The stack hedge has higher tracking error but lower liquidity costs. I'll talk more about stack and strip hedges down the road. Brad Williams, Frugal Finance. Thanks for watching.